Hi, everybody. This is Dan Sheridan. Welcome on this beautiful Saturday morning. And we're going to talk about today a little bit why I think SPX will be a bit choppy, mostly range bound rest of the year. And let's look at this. And we'll also talk about some trade ideas for next week, the FOMC meeting, and we'll look at a little bit what happened last week. But again, mostly the focus on some trade ideas and different things that I'll be looking at Monday morning, but I'll tell you those. All right, let's jump in. So if you look at the SPX uh, right here and you look at last week was mostly a nothing burger. Say, what do you mean, Dan? I'm out of the country. Maybe my definition of nothing burger might be different than yours. Well, let's see. If you look at the last five trading days, you're basically up. SPX, if you look at just the opening on Monday to Friday, we're up 60 points. If you look at Friday to Friday, however you look at a week's activity, Friday to Friday, close to close, we're up 21, well within the expectation of what the market was going to do, the expected move, and we'll talk about that in a second. Uh, um, the um, yeah, the if you look at the activity, really since November 20th, keep going to that date, which a little bit over 2 weeks, right? Little bit over 2 weeks, we've basically been up what, 340 points, twice what the expectation is. So that's been this big move. So sometimes I hear this Christmas rally. Well, what the heck, excuse the expression, has the last two weeks and 2 days in the market been, right? I'm not saying that's the Christmas rally, but is that a little bit of a rally? Double the expected move if you look at standard deviations and stuff, 330 points. As they say, good grief, Charlie Brown. We need a little bit of downside. When you look at this statistically, look at from November 21st up 1, 2, 3, 4, 5, 6, mostly every update, a few small, negligible, maybe down days overall, but the trend has been up. And again, remember, we're up 17% for the year. 17% for the year. The two previous years been up 20%. I don't know. I'm not necessarily drinking all the Kool-Aid. I'm not saying, I mean, it looks like we'll definitely probably end up for the year, but we're up 17%. I mean, again, I think we'll be mostly range bound, some two-way, but choppy. I mean, here, you can look at this and say, over the last little bit less than a month, right? We've had two-way, but it's been pretty extreme, right? Uh, down X amount of days, up X amount of days. So let's get into as far as before I look at trades, what's the main uh, what's the main reason I'm looking at uh, a bit of chop range bound? Well, let's just look at what the actual numbers say instead of my, or your stomach feeling or Fibonacci or Fibonacci. Charts are fine, but let's look at this. If you look, let's just look at next week. With the FOMC meeting next week, the expected move for next week is about 100, 1, 2, 3, 4, 5, about 100 points up or down. What does that mean? It's a one standard deviation. They're saying there's a 68% probability. We close Friday at 68.70. We'll be up 100, 69.70, down 100, 67.70. Well, let's carry that through. What's the projection for the end of the year? If I look at December 31st here, okay, the end of the year, they say 218 points. So they're saying there's 68% probability will be plus or minus 218 points from where we're at right now. We're at 68.70. So if you go up about 220 points, 69, 70, 70, you got about 70, 90 on the upside. If you go down 220 points, 66.50. So Dan, tell it to me straight. They're saying it's a one standard deviation, 68% probability will be between 66.50 and 70.90. All right, 218 points. Dan, what's 218 points? It's about 3% in the SPX, right? Not a big deal. Not a lot of points, right? Um, uh, and um, and so that's what I'm seeing, but mainly because we've been up, right? We've been up. We're 16% for the year, right? And could it be? You say, well, I think we could be up 20% for the year. Well, it's only about 3% more, right? So I think we'll continue this chop. I mean, we've had, what's marked the last 3 weeks are these big candles, right? A lot of big candles. So what does that mean? You look at these candles, the distance between the high and the low, many of them, or what I would consider a big candle in SPX, over 70 points. I mean, here's this candle. That's 100 points on November 13th. The big daddy on November 20th, that candle was 660, 730, 240 points. That's like the big kahuna. That's like a tidal wave. But a lot of these were big, but it slowed down. The last week, I mean, we had a candle here on 12/3, which was last Wednesday, 50 points. But these are more, these are tame, right? These are, 2 foot waves in the ocean. Nothing major happening. And we're above a lot of I've got a 50 moving average here, a simple moving, I've got an 8 and a 21 EMA exponential. Now, things can change, right? Um, if you ask me, what do I think? I think we're due just because we've been up a lot. Could we have a little bit of, uh, a down day or two? That would be very normal, right? Just if you don't have rain for a while. And if we go down 1%, 70 points, so 70 to 100 points would be reasonable. That's the expected move for the week. So again, sometimes it's good to look at, as we look at the charts, as we examine our stomach, our belly button, what we think. But these expected moves and standard deviations and things like that, they're based on numbers, right? In the current volatility, which is near the low end of the range for the year, and we'll talk about that in a second. Um, so I think it'll be decent for range bound, but I think it's, you're going to expect some two-way, right? Some two-way action here. What else do I want to just address real quick? Uh, the other thing, if you look at like the sectors in the SPX, look at the four main ones, XLK, uh, you know, that's been, that's, what is that? 30 some percent of that's 30 some percent of the SPX. So obviously that's a big one. That's rare. But look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, nothing wrong with drinking the Kool-Aid, but I'm just saying, if you look statistically, the more days we're up, again, I'm not saying we're going to go down a lot, but you have a little bit of pullbacks, and I would keep that in mind. Obviously XLK isn't range bound, it's been trending more. The other big ones in the sectors, uh, let's look at XLF, which is your financials, and that's, what is that, 10 to 13% in it, and that's been pretty high. You've had a big candle on Wednesday, and you know, these are the strong ones. And I keep an eye on that. What are the other two? that are the big ones. XLK, XLF, XLY, you know, at least keep an eye on these four. Again, XLY, very similar story. They're all above the moving averages up there. XLY is your um, consumer discretionary. And then the last one is the communications. And let me find that one. Communications is, I forget these at times, uh, XLC, right? These are the four big doggies in and that was a big candle on Friday. XLC is your communications. Um, so that will give a little indication of what we're doing. So it's choppy, even though you're getting some two-way, you're getting some range. Last week was more range bound. It's choppy. And so you say, well, so what should we look out for? Well, when you're making decisions on whether you want to trade or whatever, we do a lot of range bound type trades. It is important that you what type of market. So when it's more range bound, I'll pick my spots during the week. Next week, the big catalyst is FOMC, and we'll talk about that. So what are some ideas that I'd be looking at for trades next week? Again, I'm using Costco as an example. I think earnings are next week. You say, how do you ever determine, how do you know when earnings? I mean, obviously you can find out when earnings are, but another way you can see as you look at, for example, Costco, you can see here the closest expiration they have is December 12, which is Friday. But look at the implied volatility, almost 38. Then it drops pretty much. So it'll be next week. So I'm just using Costco as an example, but I want to address this to, anybody out there if you own stocks, period. Um, and they've been up a lot. Just something simple like getting a little more downside protection. So let's say somebody was long Costco, 100 shares of stock, and and coming into earnings. The nice thing, so I'm looking at the DEES 12, which is next Friday. The It's giving you the DEES 12 900 call, which is $5 out of the money. That would have a delta of, let's just see here. The 900 call would have a delta of 47. It's relatively close to at the money. Now, this is an expensive stock. If you're long Costco, it's about $89,000 to buy 100 shares of stock. I don't know how many people carry that in their wallet. And so if you're doing a covered right, it's going to be very expensive because you got to buy the stock. But if you do have the stock, and you sell like a 900 call against it for $15, that gives you a little bit of room on the downside, right? Maybe down to 880. You say, well, how'd you figure that out? Well, the premium of the call is 15 bucks. So that gives you some help on the downside. The expected move in Costco through next Friday is about $36. So if we go down, selling something a little more meat in it. Usually covered riders will sell a 20 Delta call or something far out of the money. But are there times, maybe if you want a little more protection, here you got $15 to the downside. Now you might look at a chart and say, Dan, you don't understand. Look at, we've been beaten up here. We've come from September, almost 3 months ago, we were trading at 981. We're down about 100 points. You know, if you're okay, and if you're pretty comfortable, hey, just long the stock, don't sell any call. But if you're saying, hey, I'd like a little downside protection, look to sell more of an at the money, like a 40/50 delta call. You get some more downside. Now, this may be better in stocks that have gone up a lot. If you have a stock that's gone up a lot, just going into the end of the year, maybe you want to get a little more downside protection, sell an at the money call. But as you can see here, a covered right's about $90,000. What if you said, you know what, Dan, I don't want to put up $90,000 or so to do a covered right. I got $1,800 under the mattress. What if I use that? Sure. You can do something called a long diagonal or a poor man's covered right. You're selling the same D's 12 900 call like 6 days away. But I'm going out, 40 some day, January 23 in Costco would take you all the way to, that's 48 days. And I'm buying an at the money 900 call. A little bit out of the money, but relatively at the money 900 call. And then uh, I'm selling the 900 call and I'm buying a strike 5 points underneath it, right? So I'm buying the 895s at the money out to January 23rd, and I'm just selling 5 points up. So I'm leaning on this trade diagonal about six deltas long, right? And it's only $800, right? It's a covered right position. It's got, as you look at the graph, it's kind of a combination. It's like, uh, trying to think, and was that Narnia or one of those? We have the Charles, the half horse, half man. This is, you look at the graph and you say, Dan, I see a little bit of calendar, I see a little bit of diagonal. As Donnie and Marie would say, a little bit country, a little bit rock and roll. Yes. And 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 that's what this is, but it's dramatically less capital. And the idea with a diagonal is the D's 12, we sell the D's 12s, if we go up, we get some really good yield potential. And if we go down, if we need to, we have some room because of the call we sold. But on the downside, I can just, I've got plenty of room between D's 12 and Jan 23. So I can roll the call out the same strike or down 5 points. And on the downside, I can continue to pay for the cost of the long call. And that would be kind of a covered right. If we switch over to SPX for next week, with the volatility low, I'm going to be looking more at calendars. So here would be an example of the calendar. I'd probably be looking at Monday morning. Um, give you an example here. Um, here 26. This is the December 26th, right? December 26th, you can see right now is 20 days out, but again, I'm looking at it on Saturday. December 20th, but it's a Friday, right? So when I look at it Monday, it'll be about 18 days to expiration. Tuesday, it'll be 17 days. So I might look at this and say, all right, I'll do a calendar because we've been up a lot for a lot of days. I want to stay neutral, but give me more room to the downside. So, it might look at something like this, where it's 68.70. If we opened up at 68.70, again, VIX is some of the lowest levels of the year, 1540. So this is a strategy that can benefit if volatility goes up. So, just looking at an example of selling the D's 26 expiration. And on Monday, that'll be about 18 days from expiration. And let's say I go 20 points under the mid. Dan, are you bearish? Not at all. Not at all. Bearish or bullish, I don't know any more than you do, right? But, and let's say even go another 10 points, 68.40. All right. So you look at this and you say, Dan, are you saying with us at 68.70 that you would place a calendar maybe at 68.40? So Dan, you're bearish. Well, I'm not bearish. I'm looking at, if you look at this trade, is this a bearish trade where I'm minus 0.13 delta short? Go into an option store and say, hey, I'm minus 0.13 short. I think the market's going to collapse. They say, get out of here, right? No, I'm just giving myself more room to the downside, extending my tent to the downside. But if we go up, I'm pretty flat, right? So I'm preparing. And this would be about 600 bucks. That's one. Let me just show one. That's a range bound. Also, we'll be looking at a double type strategy for uh, for next week. And I'm going to give it, and I'll talk a little bit in a second about how you could join us for next week at a cheap price to look at some of these different strategies. But one other strategy that worked well the previous week, because you had a catalyst, right? You had a bit of a catalyst on Friday. You say, what was the catalyst on Friday? We had the PCE unexpectedly. You also had the Netflix kind of news, but it took the market up hard, 38, 39 points at the opening, boom, and then we backed off. And the trade I'm going to show you, reverse iron condor, works well. And but I was thinking probably Monday morning we'll look at one for like Wednesday or Thursday, but I'll just give you an example one for Wednesday. Dan, why would you put it to Wednesday? Well, what's coming up Wednesday? The FOMC. Now, you could wait till Monday or Tuesday and maybe put it on Friday expiration if you think more there'll be a ripple effect after. But I'll give you an example of what this looks like. And so we're looking at SPX. If I look at, let's look at expiration Wednesday. Just pick the what do you call it? The FOMC. And I'm just going to go buy Iron Condor. And, you might look at like generally on these, many ways to do it. I'll just show you an example of one. Um, let's see here. I'm going to buy an out of the money put, like 40 points out of the money or so. And I'm going to buy an out of the money call, roughly 40 points out of the money. So 69.10 call. Is that, you say, Dan, is that a strangle buying an out of the money call and put? Yeah, yeah. What expiration are you doing? D's 10. So, and then 68.30 put, I'm buying. And let's just go, we usually will do a 20 wide. That would be about a little over $1,000. Here it'll make it cheaper. Against the strangle, the long strangle, I'm going to sell another strangle further out of the money. I'm going to sell the 68.20 puts 10 points underneath my long put, and I'm going to sell the 69.20 calls above. Now this is a little more, $5, 5.90. Say, hey Dan, what do you call that? Reverse iron condor. Uh, it's long gamma. What does that mean? Long gamma, positive gamma of 0.05. What does that mean? It means that my deltas as we go up, I get long deltas. I like that. As we go down, I get short deltas. I like that. How do you lose? Right? I mean, why would I have to pick which direction the market's going? If it goes up, I'm getting long deltas. That's good. I can make money. I mean, here's the current underlying. If we go up, happy days are here again, goes down, happy days here again. Is there a negative part of this? There is, my friend. This is a negative theta trade. When would I put this on? If I'm looking for a catalyst, what's the catalyst? You got FOMC, market's been a bit choppy, but I need something generally, not always, but generally. And so that's what I'm looking at. If I can get a 40 or 50 point move from Friday's close at one point, up in this area, up in this area, we can we can get a profit on this trade or one side. So that's something we did last week. We'll do that, looking at that again this week. Anyway, just some ideas, some thoughts uh, this week. If you'd like to join us, we have as the one time a year we'll put our subscription model of about $99 for everything we have, right? We have 2 hours of live content. It's recorded. We have Discord where we post our live trades and you can get that sent to you. We have our on-demand classes uh, on there. Uh, Everything we have is on there at $99 a month. Cancel anytime. There's no commitments here, just paying for a month. And I would, for $100, come in, check us out next week. I think the sale ends on this Friday or this Sunday, tomorrow. And and I think that'll be a help this week, even if you're a beginner. We've got quite a bit going on for the beginners this week uh, to help get you up to speed. But folks, have a nice rest of the weekend, and we'll see you later. Thanks.